All right, the first one is probably going to be to upgrade your disability insurance. Most of the time as a resident, you can only buy $5,000, maybe $7,500 worth of coverage. And most attendings probably want and need more coverage than that in the event that they get disabled. Typical attending amounts seem to range from $10,000 to $20,000. Now remember, you have to not only be able to live off that amount, but you have to also be able to save for retirement because this policy is only going to pay until you're 65 or 67. So take a look at your disability insurance. If you don't have it yet, for heaven's sake, go get it. You should have bought it as an intern, but if you still don't have it, go get disability insurance. But it's a good time to take a look at it. Make sure you have enough. Maybe buy another policy. Maybe if your health has changed or you took up some dangerous hobbies, exercise your future increase option rider and get that in place. Same thing for life insurance. If you have anybody else depending on your income, you need term life insurance, big fat policy, some sort of 7-figure policy. Maybe you had $1 million as a resident. Maybe it's time to bump that up to $3 million or something like that. So take a careful look at that as a new attending. While disability insurance is kind of expensive, life insurance is pretty cheap. No reason not to have enough. Likewise, while we're talking about insurance, it's a good time to put an umbrella policy in place. Remember, an umbrella is an excess personal liability policy that you stack on top of your auto insurance and on top of your homeowner's insurance. You usually buy it from the same people that you're getting those policies from. And instead of having a $50,000 limit, you now have $1 million limit or a $3 million limit or a $5 million limit. And these are pretty cheap. Just a few $100s a year gets you way more coverage than your state minimums on your auto policy. About 80% of umbrella policy claims are actually auto related. So it's really mostly an excess auto liability policy. But think about it. You run over some CEO driving a Tesla, $50,000 isn't going to go very far. That's not even going to pay for the car, much less the medical bills. And then the lost earnings from that person you hit, you need more liability coverage than that. Next thing is your student loans, okay? If you don't already have your student loans taken care of, now's the time to make sure you have a plan in place. If you need help putting that plan in place, we recommend studentloanadvice.com. If you already got it figured out, chances are good that you need to refinance. If you haven't refinanced private loans already, make sure you do that. You might want to do it again now that you're an attending and qualify for better rates. But this is also the time, if you're not going for forgiveness, this is the time to refinance your federal loans. Go get a cash bonus, get a free Fire Your Financial Advisor course, get a lower rate, get better service, and get those suckers refinanced. It's not unusual at all for me to see people take their loans from 6% to 2%. The shorter the term, and if you're willing to run the interest rate yourself with a variable rate loan, the better rate you get. And what's interesting is people who took that advice the last few years and then had rates fall on them ended up having student loan rates under 1%, which is pretty phenomenal, right? Almost everything you're paying at that point is going toward principal rather than interest. So that's a good thing. This is a good time if you don't already have it in place, and I hope you already do, but if you don't, put a budget plan in place, a spending plan, right? You need to be living like a resident at this point in your life, right? You come out of residency, this is the live like a resident period. It lasts 2 to 5 years. Okay, you don't have to live exactly like a resident. You can give yourself a tiny raise, but don't grow into your attending income all at once. Take the difference between your attending income and your resident lifestyle and use it to build wealth, to pay off student loans, save up a down payment on your dream home, max out retirement accounts, build an emergency fund, all that kind of stuff. The issue with most new attendings is you have more to do, more good uses of money than you have money. And so you have to prioritize those according to what your priorities are. But eventually the money's going to run out probably before your good uses for it. And that's why living like a resident matters, because it gives you way more money to spread among all those great things you have to use your money for. If you have credit cards, you got credit card debt, you are not unusual. Many new attendings have been dragging credit card debt all the way through medical school and residency, just making minimum payments. Now's the time to wipe that stuff out, right? As an attending, every month you're having $15,000 to $40,000 hit your checking account. Wipe out those credit cards. How big can they be at this point? Do you really have more than $5,000 or $10,000 or $30,000 in credit cards? You can wipe those out in just 2 or 3 months. Same thing with your car loan. You got some $8,000 car loan because you had to replace a car in residency. Go knock that out and be done with it. Get it out of your life. Simplify your life. Make sure you have a written financial plan in place. If you don't know how to do that, To put that plan in place, try the Fire Your Financial Advisor course. If that doesn't work, at least the course will teach you how to find a good financial planner that can help you do that. You can find financial planners as well at the White Coat Investor website under our recommended tab. And of course, now is a great time to start paying on those student loans, right? The whole point of Live Like a Resident is to get that schooling paid for. You're not really done with medical school until you've paid for it. So let's get it paid for, right? If you're like most doctors, average doctor, average debt, you should be able to wipe out that medical school debt in 2 to 3 years of living like a resident. And then you're done. You're free from it. If you want to change careers, you can. If you want to cut back, you can. If you want to rush toward financial independence, you can. If you just want to live the good life, you can, because you don't have those loans hanging over you every month. And that $2, $3, $4, $5, $6,000 a month, whatever you're paying toward them every month, you can now redeploy toward your other financial goals, or you can just take a really great trip every single month. It's really up to you, but get that knocked out and out of your life. Okay, another great thing to consider when you're a brand new attending is Roth accounts, right? In general, Roth is good for residents unless you're playing games with your student loans. Try to get more of them forgiven. You want to use Roth accounts in your lower earnings years. That includes residency years, fellowship years, and the year you come out of training. Because remember, you got half a year of income, low income as a trainee, and half a year of higher income. So that's still lower than your peak earnings years. It's a good year to use Roth accounts. Also maybe a good year to do a Roth conversion, right? If you had a tax-deferred 403B or something during residency, if you have the money to pay the taxes, consider converting it to a Roth IRA right now at a lower tax bracket than you'll be in next year. All right. Make sure your job is working out. Okay, make sure the job likes you and you like the job. That usually takes a few months, maybe 6 months, maybe 12 months. And then start working toward buying a house. Okay, you don't have to wait until you have the cash to buy a house. It's okay to use a mortgage. You don't even have to have the cash to make a 20% down payment. I'm okay with you buying a house using a doctor mortgage, right? Less than 20% down. They will work with you based on your contract income rather than your actual tax statements or your actual pay stubs. And they'll only look at the required student loan payments that you have to make rather than the total amount you owe. That's what a doctor mortgage is. And you don't have to pay private mortgage insurance, PMI, that mortgage insurance that they make you pay when you put down less than 20% in order to protect the lender from you defaulting. Doctor mortgages don't require you to pay that. So go ahead and buy a house once you know you're in a stable personal and professional situation. Get a real emergency fund, right? You probably had some tiny little thing as a resident. You know, if you had a $2,500 emergency fund as a resident, maybe now's the time to bump that up to $10,000 or $15,000. The usual guidelines are 3 to 6 months worth of your living expenses. So look at what you spend, multiply it by 3. That's your emergency fund. Figure out your retirement accounts. You got a new employer, maybe you're self-employed and you want to open an individual 401k, whatever. Figure them out. Figure out what's available to you and start maxing them out, right? If you start saving for retirement from day one, you will probably work half as long as your peers that don't do that. Those early dollars really become the largest part of your portfolio down the road. So get those retirement accounts going. You should be able to do that even while you're paying off student loans, even while you're building an emergency fund, even while you're paying off credit card debt, right? Because you're living like a resident. So you have this huge amount of money between your attending salary and your resident lifestyle. And, if you're driving some terrible car, right, now's the time to start saving up for a better one, right? Saving up so you can pay cash for it, not going out and buying a $120,000 Tesla on credit, but saving up to pay cash for the car you want to drive. And maybe you take a little trip, reward yourself for finishing residency, right? I'm not saying you got to, have full-on austerity measures, but that's the general concept, is you live about like you were as a resident while earning like an attending. All right, I hope that helps, gives you some financial priorities as a new attending. It's hard for me to say prioritize your emergency fund over your credit card debt or your student loans over maxing out retirement accounts. My hope is that by living as a resident, you'll be able to do it all at once.